A silent shift is moving through the global financial system, and most people do not even see it yet. The rules that have controlled oil trade for almost 50 years are being questioned. The United States dollar has long been the king of oil pricing. Every major country needed dollars to buy energy. That demand helped make America powerful. It helped the dollar become the world's reserve currency. But now a serious challenge is rising. What if the world stops using US dollars to buy oil? And what if China's currency takes over instead? This is not a small debate inside economic circles. This is a battle over who controls the future of global money. In this video, you will understand what the petrodollar really is, why it gave the United States enormous influence, what role Janet Yellen's recent warnings to global banks play in this story, and why China is pushing to price oil in its own currency, the renminbi. You will also learn why some countries are quietly supporting this shift, why others are nervous, and what it could mean for inflation, interest rates, and the strength of the US dollar. For decades, oil has been priced almost entirely in dollars. After the 1970s, oil crisis, a system formed where major oil exporters agreed to sell oil in US dollars. In return, they gained security partnerships and access to American markets. This arrangement forced countries around the world to hold large reserves of dollars. If Japan wanted oil, it needed dollars. If Germany wanted oil, it needed dollars. If India wanted oil, it needed dollars. This constant demand supported the value of the US currency. It also allowed the United States to borrow more cheaply and run large deficits without facing the same pressure other countries would face. Many people do not realize that oil trade is not just about energy. It is about financial power. It is about control over payment systems. It is about influence over global banks. Now pressure is building from multiple directions. Sanctions have become a powerful tool of US foreign policy. Countries that fall under US sanctions often find themselves cut off from the dollar system. Banks that violate US restrictions can face heavy penalties. Recently, strong warnings from US Treasury officials signaled that global banks must strictly follow American financial rules or risk serious consequences. That message was clear. Access to the dollar system comes with conditions. For some nations, this was not just a reminder, it was a wake-up call. When financial power is used as leverage, other powers start looking for alternatives. China has been preparing for this moment for years. The renminbi, also known as the Yuan, has slowly expanded its role in global trade. China created its own cross-border payment system. It signed currency swap agreements with many countries. It increased gold reserves. It built closer energy ties with Russia, Saudi Arabia, and other oil exporters. Energy deals between China and Russia have already been settled in local currencies rather than dollars. These moves did not happen overnight. They were part of a long strategy to reduce dependence on the US dollar. Now, the idea of pricing oil in China's currency is gaining serious attention. If oil contracts begin to shift into renminbi, even partially, global demand for dollars could weaken over time. This video will break down what that really means. Some headlines suggest the petrodollar is ending tomorrow. Others say the dollar is too strong to fall. The truth is more complex. The dollar still dominates global reserves. It still accounts for the majority of international transactions. But change in global finance rarely happens in one dramatic event. It happens step by step. A few contracts in Yuan, a few countries diversifying reserves, a few central banks reducing dollar exposure. Each step may look small on its own. Together, they can reshape the system. There are also hidden risks. If oil pricing shifts away from the dollar, the United States could face higher borrowing costs in the long run. Demand for US Treasury bonds might soften. Inflation pressures could become harder to manage. At the same time, the renminbi faces its own limits. China maintains capital controls. Investors still question how open and transparent its financial markets are. For the renminbi to fully replace the dollar, global trust would need to increase significantly. That process takes time. It requires deep financial reforms. It requires confidence in legal systems and political stability. Yet the geopolitical landscape is changing. BRICS nations are discussing trade in local currencies. Energy producers are diversifying partnerships. Global banks are navigating between compliance with US regulations and maintaining access to growing Asian markets. The tension is real. The stakes are high. This is not just about which currency is used in oil contracts. It is about which country shapes the financial order of the next generation. It is about whether the world moves toward a single dominant currency or a more fragmented system with multiple centers of power. By the end of this video, you will clearly understand how the petrodollar system began, why it became so powerful, what role recent US financial warnings play in accelerating global shifts, how China's strategy is unfolding, and what realistic scenarios could play out over the next decade. You will see beyond the headlines and understand the deeper forces driving this transition. This topic affects global markets, fuel prices, investment flows, and even the stability of national economies. It affects everyone, whether they follow finance closely or not. The global money system shapes everyday life in ways most people rarely consider. Stay with us until the end, because the final section will explore possible future outcomes that most mainstream discussions ignore, including the scenario where the dollar remains dominant but shares power in a new multipolar currency world. The coming years may not bring a sudden collapse, but they could bring a gradual shift that changes global power balances forever. The question is no longer whether alternatives are being explored. The question is how far and how fast those alternatives can grow. Welcome to our channel, where we break down complex global events into clear and simple explanations. If you want to stay ahead of major economic shifts and understand what is really happening behind the scenes, make sure you subscribe and turn on notifications so you never miss an update. The petrodollar system began in the 1970s. After a period of financial turmoil and rising oil prices, the United States reached an understanding with major oil-producing countries, especially in the Middle East, that oil would be priced and sold only in US dollars. In return, those countries received security support and access to American markets and financial systems. From that moment, any country that needed oil also needed US dollars. Japan needed dollars. Germany needed dollars. India needed dollars. Every major economy had to hold dollar reserves to secure energy supplies. This created constant global demand for the US currency. It strengthened the dollar's value. It increased trust in US Treasury bonds. It allowed the United States to finance large government spending at relatively low interest rates. Over time, this arrangement helped the dollar become the world's dominant reserve currency. Central banks stored dollars. Global trade contracts were written in dollars. International loans were issued in dollars. Oil sat at the center of this system because energy is the lifeblood of modern economies. Factories, transportation networks, electricity generation, and food production all depend on energy. By linking oil to the dollar, the United States linked global growth to its currency. That connection gave Washington powerful influence over global finance. If access to dollars could be restricted, trade could be restricted. If banks were cut off from the US financial system, they faced severe pressure. The petrodollar was not just about oil pricing, it was about shaping the global financial order for decades. This structure remained stable for many years because there were few serious alternatives. The dollar was backed by the size of the American economy, deep financial markets, strong legal institutions, and military power. Oil exporters trusted that they could invest their dollar earnings safely in US assets. Importing countries trusted that the dollar would remain stable enough to support long-term contracts. Even during financial crises, the dollar often strengthened because investors saw it as a safe haven. The petrodollar system became deeply embedded in global trade networks. Shipping contracts, insurance agreements, commodity exchanges, and futures markets were all built around dollar pricing. Changing such a system is not easy. It requires trust, liquidity, and political coordination on a massive scale. Recently, new signals began to emerge from Washington. The US Treasury, under Secretary Janet Yellen, delivered strong messages to global banks about compliance with American sanctions and financial regulations. These warnings made it clear that banks operating internationally must strictly follow US rules or risk losing access to the dollar system. For many institutions, access to the US financial network is essential. Clearing payments in dollars moves through American banking channels. Violating sanctions can result in heavy fines and exclusion from these networks. The message from Washington was firm. Cooperation is not optional. This stance was not new in principle, but the tone and timing drew attention because global tensions are rising. Countries facing sanctions have increasingly searched for ways to bypass the dollar system. When the US reinforces financial restrictions, it reminds the world of the leverage attached to dollar dominance. For allies, it may feel like protection of global norms. For rivals, it can feel like vulnerability. The warning acts as a nerve signal in global finance because it highlights the power imbalance built into the current system. It shows that the dollar is not only a currency, but also a tool of influence. Global banks now operate in a complex environment. On one side, they need access to US markets and clearing systems. On the other side, they want to expand in fast-growing regions like Asia. When geopolitical tensions rise, banks face difficult decisions. If energy trade begins to shift away from dollars, financial institutions must adapt their infrastructure. Payment systems, settlement processes, and currency risk management strategies would need adjustment. Even small changes in oil pricing can have large ripple effects because oil is traded in enormous volumes every day. The US Treasury's message, therefore, matters not only for political reasons, but also for the mechanics of global trade. If more countries perceive the dollar system as restrictive or politically risky, the incentive to develop alternatives grows stronger. China has been working on such alternatives for years. The RMB, also known as the Yuan, is the official currency of the People's Republic of China. For decades, it played a limited international role because China maintained tight capital controls. Over time, Beijing began promoting the international use of its currency. It launched cross-border payment systems to reduce reliance on dollar-based clearing networks. It signed bilateral currency swap agreements with numerous central banks. These agreements allow countries to trade directly in their own currencies without first converting to dollars. China also encouraged the use of the yuan in energy contracts with major suppliers. Deals between China and Russia increasingly use local currencies instead of dollars. Some oil shipments to China from other producers have been settled in yuan. Each transaction may seem small compared to total global oil trade, but they signal a direction of travel. The idea of pricing oil in renminbi carries symbolic and practical significance. Symbolically, it challenges the long-standing dominance of the petrodollar. Practically, it allows China to reduce its exposure to dollar-based systems and potential sanctions risks. As the world's largest oil importer, China has leverage in negotiations. If it offers long-term purchase agreements in yuan, some exporters may accept, especially if they wish to strengthen ties with Beijing. China has also created yuan-denominated oil futures contracts on its domestic exchanges. These contracts provide a pricing reference point within its own financial system. For oil exporters who trade heavily with China, holding yuan may become more attractive if they can invest those funds in Chinese assets or use them to purchase Chinese goods and services. The global demand for alternatives outside the dollar is growing in certain regions. This does not mean the dollar is collapsing, but it reflects diversification. Central banks in some countries have increased gold reserves. Others have explored digital payment platforms that operate beyond traditional banking networks. Regional trade agreements are increasingly discussing settlement and local currencies. The push for alternatives is often linked to concerns about sanctions, exposure, exchange rate volatility, and geopolitical uncertainty. Countries that have experienced restrictions on dollar transactions view diversification as a form of financial insurance. They do not necessarily aim to replace the dollar entirely, but they want options. Several real forces are driving this movement. Major economies want to reduce dependence on a single currency for critical commodities. Relying heavily on the dollar can create vulnerability if diplomatic relations deteriorate. Russia and China have already expanded trade in local currencies, especially after sanctions limited Russia's access to dollar-based systems. Energy trade between them has shifted significantly toward rubles and yuan. This change was not purely ideological, it was practical. When access to one system narrows, alternative channels become necessary. Other countries observe these developments carefully. If alternative mechanisms function effectively, confidence in non-dollar trade can grow. Oil export deals are slowly expanding beyond dollar pricing in specific cases. Some Middle Eastern producers have signaled openness to accepting different currencies under certain conditions. The shift is not uniform and remains limited compared to the overall scale of dollar-dominated oil trade. However, even incremental diversification can alter expectations. Financial markets respond not only to current volumes, but also to anticipated trends. If traders believe that more oil contracts will move into Yuan over time, currency strategies adjust, investment portfolios adjust, reserve management policies adjust. Expectations can influence behavior before structural change fully materializes. There are practical challenges to replacing or even significantly reducing the role of the dollar in oil markets. The US dollar benefits from deep and liquid capital markets. Investors can buy and sell large quantities of US Treasury securities quickly and with relatively low risk. The legal framework in the United States provides predictability for contract enforcement. The dollar is freely convertible, and capital can move in and out of the country without major restrictions. In contrast, China maintains capital controls that limit the free flow of funds. Foreign investors face regulatory complexities when accessing Chinese markets. For the renminbi to play a larger role, trust in China's financial system must continue to grow. Transparency, liquidity, and legal protections matter deeply to global investors. At the same time, economic gravity is shifting. Asia represents a growing share of global energy demand. China is a central hub in manufacturing supply chains. Many countries depend on trade with China as much as or more than trade with the United States. When trade patterns evolve, currency usage can evolve alongside them. If a country exports large volumes of goods to China and imports large volumes from China, settling trade in yuan can reduce exchange costs and currency risk. Over time, such practical considerations can expand the international role of a currency without dramatic announcements. Financial history shows that dominant reserve currencies can remain powerful for long periods, even as challengers emerge. The British pound once held a leading global role before gradually stooping to the dollar. That transition took decades and was influenced by wars, economic shifts, and institutional development. The current environment is complex. The United States still has the largest and most liquid financial markets in the world. The dollar still accounts for a majority share of global reserves and cross-border transactions. Yet the conversation about diversification is louder than it was 20 years ago. Global banks stand at the intersection of these trends. They must evaluate regulatory risks, currency risks, and political risks. If more oil contracts move into yuan, banks will expand yuan clearing capabilities. They will hedge currency exposure differently. They will manage liquidity across multiple systems. The infrastructure of global finance may become more multipolar rather than centered on a single currency. This does not mean immediate disruption, but it suggests gradual adaptation. Energy exporters also weigh strategic considerations. Accepting yuan could deepen ties with China and open investment opportunities in Chinese infrastructure and technology projects. On the other hand, maintaining strong links with dollar markets ensures access to US financial systems and global investor networks. Many producers may choose a balanced approach, accepting multiple currencies depending on the buyer and geopolitical climate. Such diversification could slowly reduce the exclusive link between oil and the dollar without completely severing it. Behind these developments lies a broader question about trust. Reserve currencies depend on confidence. Confidence depends on economic strength, institutional stability, and geopolitical relationships. If confidence in one system weakens, alternatives gain attention. If confidence in alternatives remains uncertain, the existing system retains dominance. The petrodollar arrangement has endured because it combined economic scale with strategic alliances. Any shift away from it will likely be gradual and influenced by many factors beyond oil pricing alone. The warning signals from the US Treasury highlight how closely finance and politics are connected. When access to the dollar system is linked to compliance with US policies, countries assess their exposure carefully. Some conclude that diversification is prudent. China positions the renminbi as part of that diversification path. Whether the renminbi can achieve a scale comparable to the dollar remains uncertain, but its role in trade and energy markets is clearly expanding. The interaction between policy pressure, strategic ambition, and economic necessity shapes the evolving landscape of global oil pricing and currency competition, and each development feeds into the next without a clear endpoint in sight. The global impact of oil no longer being priced mainly in US dollars would be deep and wide. Oil is not just another product. It is the foundation of modern economies. Every country needs it in some form. It powers transport, factories, planes, ships, farms, and electricity systems. Because oil is traded in huge amounts every single day, the currency used to price it becomes extremely important. If oil stops being priced mainly in dollars, the first major change would be a shift in demand for the US currency. Right now, countries hold dollars partly because they must use dollars to buy oil. If large oil exporters start accepting another currency like China's RMB, then importing countries may not need to hold as many dollars as before. Even a gradual reduction in dollar demand could slowly affect its global position. This does not mean the dollar would collapse overnight. It means the automatic demand created by oil trade would weaken over time. If fewer countries need dollars for energy trade, central banks may begin to adjust their reserves. Instead of holding mostly dollars, they could diversify into other currencies or gold. Reserve diversification is already happening in small amounts. If oil contracts expand in RMB or other currencies, that trend could speed up. The dollar's power comes from trust, size, and habit. Habit is very strong in global finance, but habits can change slowly when incentives change. If oil exporters accept RMB and can use it easily to trade, invest, and store value, then holding RMB becomes more practical. This would reduce the exclusive link between oil and the dollar that has existed for decades. Will the dollar lose power completely? That depends on how we define power. The dollar would likely remain important for many years because the US economy is still large and its financial markets are still deep. Many global contracts are written in dollars. Many investors prefer US bonds for safety. However, the dollar's dominance could shrink. Instead of controlling the majority of global reserves, it might share more space with other currencies. This would mean the United States has slightly less influence over global liquidity. It could mean borrowing costs for the US government might rise slowly if demand for US debt decreases. It could also mean the US has less ability to use financial sanctions as a powerful tool if alternative systems become strong enough. Global banks would also adapt. Banks operate where trade flows. If oil trade moves into RMB, banks will expand RMB services. They will increase currency exchange operations between RMB and other currencies. They will hold more RMB deposits. They will build stronger links with Chinese financial institutions. Banks are flexible by nature. They follow demand. If clients want to settle contracts in yuan instead of dollars, banks will provide that service. Over time, payment systems could become more balanced between several major currencies rather than centered mostly on the dollar. This would not destroy the existing system, but it would make it more multipolar. There are several possible paths ahead. One path is slow change. In this scenario, the dollar remains dominant, but other currencies grow steadily. Oil may still be mostly priced in dollars, but a growing percentage is priced in RMB or other currencies. Central banks slowly diversify reserves. The dollar's share declines gradually, but it remains the leading currency. This scenario is the least disruptive. Markets adjust calmly. Investors spread risk across more currencies. Trade continues with minimal shock. In this path, the global system becomes more balanced, but no sudden crisis occurs. Another path is a faster shift. In this case, geopolitical tensions increase. More countries decide they want protection from potential sanctions risk. Large oil exporters accept RMB in bigger volumes. Major energy contracts shift quickly. China expands financial reforms to make the RMB more attractive. If this happens, demand for RMB could rise sharply. Central banks might increase RMB holdings faster. Global trade patterns could change more quickly than expected. This would put pressure on the dollar. Exchange rates might move strongly. US borrowing costs could rise more noticeably. Investors might reassess long-term assumptions about currency leadership. This scenario would still not mean instant collapse, but it would mean visible change within a shorter time frame. The third path is chaos and instability. This would happen if the shift away from the dollar occurs suddenly due to a major political or financial crisis. For example, If a large group of oil producers announces at once that they will no longer accept dollars, markets could react sharply. Currency markets might swing heavily. Stock markets could fall due to uncertainty. Investors often fear rapid change more than slow change. Banks could face liquidity stress if they are not prepared for sudden currency shifts. Governments might respond with emergency policies. In this scenario, volatility would increase. Energy prices could spike. Exchange rates could move unpredictably. Fear can spread quickly in global finance because markets are deeply connected. Even in a chaotic scenario, the long-term outcome would depend on trust. Currencies are built on trust. If investors believe the dollar remains safe, they will continue to hold it. If they believe RMB offers stability and access to growth, they will increase exposure there. Trust is influenced by economic strength, political stability, rule of law, and openness of markets. The United States still benefits from strong institutions and transparent financial systems. China benefits from economic scale and trade networks. The competition is not only about oil pricing, it is about which system offers reliability in uncertain times. If oil stops being priced mainly in dollars, one major effect would be on exchange rates. Currently, high demand for dollars supports its value. If demand weakens, the dollar might depreciate over time. A weaker dollar could make US exports more competitive, but it could also make imports more expensive. This could increase inflation inside the United States. Higher inflation could push the Federal Reserve to adjust interest rates. Interest rate changes affect housing markets, job markets, and consumer spending. So a shift in oil pricing can travel through many layers of the economy. On the other side, if RMB becomes more widely used in oil trade, China would gain more influence over global liquidity. It could shape credit conditions for countries that rely heavily on Chinese trade. However, China would also face new responsibilities. Greater currency use means greater scrutiny. Investors would demand transparency. Capital controls might need adjustment. Financial openness could increase. With greater currency power comes greater exposure to global shocks. China would need to manage capital flows carefully to avoid instability. For developing countries, a multipolar currency world could bring both opportunity and complexity. They might benefit from having more currency options for trade. They might reduce dependence on one dominant system, but they would also face more exchange rate management challenges. Holding reserves in multiple currencies requires careful balance. Sudden swings in one currency can affect debt payments if loans are denominated differently from trade earnings. Risk management becomes more complex in a world with several strong currencies. Global banks would need to adjust internal systems. Payment platforms, risk models, compliance frameworks, and capital requirements may evolve. Banks that operate in both Western and Asian markets would need strong relationships in both systems. Technology will also play a role. Digital payment networks and central bank digital currencies could speed up currency diversification. If digital platforms allow instant settlement across borders without relying heavily on traditional clearing networks, currency competition may increase. Energy exporters would likely adopt a flexible strategy. They may price some oil in dollars and some in RMB, depending on the buyer. This diversification reduces dependence on one market. It also spreads political risk. Such mixed pricing could become normal rather than exceptional. Over time, the idea that oil must be priced only in dollars may fade. In a slow change scenario, the shift might take decades. The dollar could decline from a very dominant share to a somewhat smaller but still leading share. The RMB could rise gradually as China continues reforms. Markets would adapt smoothly. Investors would adjust portfolios. Governments would update reserve strategies. The system would look different but stable. In a fast shift scenario, headlines would change quickly. Investors might rush to buy RMB assets. Currency traders would react strongly. The US government might respond with policy adjustments to defend dollar strength. Interest rates could move. Trade negotiations could intensify. The speed of change would create more volatility. In a chaos scenario, fear would dominate markets. Sudden announcements or geopolitical conflict could trigger panic selling. Oil prices could spike due to uncertainty. Stock markets could drop sharply. Governments might coordinate emergency measures to calm markets. Over time, stability would likely return, but confidence could be shaken. The key idea is that oil pricing is not only about energy. It is about the structure of global money. If the link between oil and the dollar weakens, the dollar's automatic demand weakens. This does not mean the dollar disappears. It means its position becomes less exclusive. The world may move toward a system where power is shared between multiple currencies. In the coming years, the most likely path may involve gradual diversification rather than dramatic collapse. Yet history shows that gradual shifts can eventually lead to major change. Whether it fully ends or not, the petrodollar's grip is loosening and the global money world may never look the same. The global money system is entering a new phase. The dollar still stands strong, but pressure is building. China is pushing forward. Oil markets are watching closely. Banks are adjusting quietly. Governments are calculating risks. The shift may be slow, it may be fast, but it is no longer just theory. It is unfolding in real time. This is not just about oil. It is about power. It is about control. It is about who shapes the next chapter of global finance. The decisions being made today could influence currency markets, inflation, trade, and investment for decades. Now I want to hear from you. Will oil really be priced in Yuan in the future, or will the dollar remain on top? Drop your opinion in the comments below. Let's start a real discussion. If you found this breakdown clear and valuable, make sure you subscribe to the channel. Finance trends are moving fast, and we bring you the signals that matter most. Like this video so more people can understand what is happening behind the headlines. Share it with anyone who wants to stay ahead of global economic change. The financial world is shifting. Stay informed, stay prepared, and we will see you in the next video.